for the upcoming deadline. It has been delayed this year, but we have a special guest with us, Michael Plaks, who's going to help us make those decisions. Moderating for us today, we have Katie Schuler, and I'm going to share some screens about who Quest Trust Company is and what we do before we have our special guest come on today. All right, here we go. So who is Quest and what do we do? Oh, there we go. So we are a company built by two brothers, Nathan and Quincy Long. The company is built by investors for investors. We are the largest self-directed custodian in Texas with over 20,000 active investors around the country. So we are able to service all around the 50 states with $2 billion in assets under administration. Big disclaimer here, let's keep everybody safe. This is not for any legal, tax, or investment advice. This is for educational purposes only. Please make sure you are contacting your CPAs and your attorneys before making any investment or tax decisions. There we go. So what is a self-directed IRA and why should you have one? So self-directed, honestly, is just a marketing term, meaning you are in the driver's seat. You get to tell us what you would like to invest in. So an IRA is an IRA is an IRA. An IRA outside of a self-directed account is governed just the same way by the IRS. And why should you have one? Diversification. So outside of just regular mutual funds, stocks, and bonds, this is another way to diversify your portfolio with private assets. Things like real estate, promissory notes, and private entities such as LLCs. The tax saving benefits. We have tax deferred accounts such as our traditional IRA, and we also have accounts like the Roth IRA, potentially giving you tax-free distributions at retirement. Social investing. This actually gives you an opportunity to give people who can't get traditional mortgages or things like that in their lives, and you can do something like private money lending to give them that help. Big plus there. Also, it gives you the advantage to invest in what you know best. If you really know real estate or promissory notes or oil and gas, this gives you an opportunity to invest in that way. So here at Quest, we have 7 types of accounts. They're broken down in 3 different categories. Our first 2 are our personal accounts, the traditional IRA and the Roth IRA. Our employer plans, the SEP IRA, the simple IRA, and our solo 401k. And our 2 specialty plans, the health savings account and the education savings account. I'd love to tell you more about these plans today, but we just don't have enough time. Please contact me, our other IRA specialist, for a free consultation, and we'd love to tell you more and how these can work for you. Investment choices. These are honestly just a few, but these are our main big categories. Real estate, such as single family homes, multifamily, condominiums, options, private entities, such as LLCs, promissory notes, you see the list there. We even have oil and gas, all kind of things like that. So our clients find their investments, do their own due diligence, and then come to us and tell us what they would like to invest in. Of course, since we're talking about taxes today, we still have time to get those 2020 contributions in. It has been extended for the whole country up until May 15th to get those 2020 contributions in. So we've added this slide in to make sure you know those limits for your age and for the year. So make sure to get those contributions in. The IRA specialist can absolutely help you in how to do that into your Quest account, either that you have with us or open up a new account and help you get started. So endless free education. This is something that I really love about Quest, something that is very unique to this company that I found from working with other financial companies. It's free and it's amazing. So our YouTube channel is very robust. All of the webinars, including this one, is on our YouTube channel. We have our education center on our actual website. Katie's going to be putting all of this education, all of this information in our chat box. Our weekly webinars on Tuesdays and Thursdays at noon Central. Of course, our self-directed Saturday at noon Central every Saturday we have for you. And then our virtual networking happy hour. This is a really unique event. It's the first and third Wednesday of every month at 6:30 Central. Investors from all over the country can come and get together, have their time in the sun, get a little time with the camera, share what they're doing, share what they're looking for, have a glass of wine or a beer with us. We'd love to have you. It's a really neat event. QuestCon Live is back, coming up in less than a month now. Katie's going to put the link to this event in the chat box as well. Make sure you register with this event and come check us out. This month's promotional reward is actually double rewards. So referring a client to Quest Company will actually get you a $50 credit in your account and get the new client a $50 credit off of the new account opening fee. So really big thing there. Make sure to contact an IRA specialist to help you get this started for you. So how to get in touch with an IRA specialist. We're actually really easy to get in touch with. We have a QR code there on the left. You can chat with us live. If you notice, if you ever go to our website, a little box pops up on the right-hand side of the corner, chat with us live. These are actual real people. It's actually me on Tuesdays and Wednesdays. It's not a robot. Give us a call, 855-FUN-IRAs. We do really make IRAs fun and exciting. You can email our certified IRA specialist, our main email, iraspecialist@questtrust.com, or email me personally at nicole.baco@questtrust.com. Now, for the man and the topic of the hour, here is Mr. Michael Plaks sharing his information about the tax information for this year coming up. Let me stop sharing my screen. All right, sir, take it away.
Okay, thank you, Nicole. Thank you, Quest. It's always a pleasure to present for you guys. And today I was invited to talk about the new deadlines, not the new actually, like the current deadlines that you have and the current decisions to make in view of April 15th IRS deadline. Guess what? From the time we agreed on this presentation, the deadline has been moved, as Nicole already mentioned. So the deadline has moved, so some of the decisions are a little bit postponed. You have a little bit more time to procrastinate. But what also happened is we got more new laws. So on March 11th, we got a major new law. And what I decided to do is change the plan for this presentation and combine the two topics. We are going to talk a little bit about IRA-related decisions in view of the IRS deadlines postponed now, but then I'm going to spend the second half of today's presentation talking about the new laws because there is a whole lot of confusion and misunderstanding on what is going on. For those of you who don't know me, not familiar with me, I'm Michael Plaks. I'm black belt in real estate taxation. Here is my black belt. Here are my red gloves, which I use to beat up Uncle Sam, who is conveniently social distancing behind me nowadays. But now for the presentation, gloves are off. I'm going to start my presentation, and we are going to talk about all those different issues that I mentioned. Okay, so first is, okay, again, about me is on my logo. You can see me beating up Uncle Sam. I have been doing that since 1996. Have a federal licensed of enrolled agent, which is very similar to a CPA license, but slightly different. Not going to talk about that right now. The important part is that I have been working with real estate investors exclusively for 25 years. And my company is called Rai Tax Firm. We beat up the IRS for you. So as I already mentioned, today's plan is twofold. We are going to talk about the deadlines and we are going to talk about new laws. So on this slide, it has our plan. So we start with talking about 2021 IRS deadlines. Then we talk about IRA contributions, talk about employer-sponsored retirement plans such as 401k. Then we talk about Roth conversion. We'll mention COVID-related distributions and what has changed in that area. And then in the second part, we'll talk about general tax laws that are new as we speak today. There was a December law called Consolidated Appropriations Act. And then there was a March law, which is called American Rescue Plan Law Act. Okay. So as part of that, we will talk slightly about stimulus, unemployment, and various other programs. Very briefly, we'll talk about PPP loans or grants and what is new in that area, what is new with employer credits. And I will close by talking a little bit about proposed tax law changes, meaning changes that are not yet the law, but possibly could become so. Of course, talking about that, we have to start with disclaimers. After all, this is a tax presentation. So first, nobody has all the answers. If you come across people who claim that they have all the answers, well, run away. These people are delusional, or they are aware that they don't have the answers and lying to you, which is worse. Well, I don't know, frankly, what is worse. What we are going to do today, of course, is only overview. Yes, we have, like, maybe we'll spend 40, 50 minutes talking about that, but it's still very little time considering the volume of material that is covered by the new laws that is potentially up to questions. The good part about that is, if you follow me, is I do my own webinars. Yesterday, I filmed a free webinar, entire hour, talking about this brand new law from March, which has more details that we have time to cover today. Now, what I'm going to do is definitely not a tax legal advice. You cannot sue me for that. Oh, well, you can. It's America. You can sue anybody for anything, anytime, but it probably will not work too well, because I disclaim that's not a tax legal advice. You would need to be my client to receive that, and that would be one-on-one. Speaking of one-on-one, I won't be able to answer your individual questions if you reach out to me through email or on social media. We will have a few minutes at the end, maybe for some Q&A here, but beyond that, reaching me later and asking, oh, Michael, like, I saw a presentation, can you clarify that for me? Sorry, will not be able to do that, do not have time for that, but I will mention in the middle of presentation where you can ask those questions and get them answered. We also, as a firm, do not provide consultations just a standalone consultation. You will have to be our full advisory client for that. That's the model on which we work, and I'll mention a little bit about my company later again. And so now, finally, to the meat of our presentation, we'll talk about that. But I want to bring your attention to the fact that at the top of every slide of mine, I do something that unfortunately very few of my colleagues do. I put the date when the presentation is done. It's critically important, guys, because things change weekly, at least sometimes daily. Okay, there was a new update related to PPP yesterday. Okay, so presentation done the day before yesterday would have been outdated, at least in that one area. So whenever you read some article, some blog post, or watch a YouTube video, make sure to figure out when exactly it was filmed or written, because things get outdated incredibly fast over those pandemic months especially, and things are not going to get any more stable in the near future. So things change very rapidly. Answer that was correct yesterday may be wrong today, and unfortunately, that's the environment where we operate. Okay, so mine is as of today, nationwide, April 15th has been delayed to May 17th. Why not May 15th? Because May 15th is a Saturday. So they pushed it 2 more days to Monday, the 17th, which means IRA contribution deadline, which traditionally was April 15th, this year nationwide is May 17th. While those deadlines have been pushed to May 17th, one little quirk that confuses some people is the estimated payment deadline of April 15th for the first quarter of this year has not been extended. That payment is still due April 15th. However, payment for 2020 taxes, if you owe taxes for that year, that one has been moved to May 17th. Now, Quest is headquartered in Texas, so am my firm, and in Texas, everything due to the winter storms was delayed to June 15th. So if you are in Texas, or if your tax firm is in Texas, then what you have is additional extension. That extension is to June 15th. And in Texas, pretty much everything got moved to June 15th, including even that first quarter estimated payment on April 15th. Now, Texas franchise tax report has been moved to June 15th. So pretty much everything. Now, in other states, you need to be careful because state policies are different. If you are not in Texas, so some states like Louisiana, Oklahoma, Texas have that June 15th deadline due to winter storms. Some states complied with May 17th IRS deadline, but in some states, state tax returns are still due on the original date of April 15th. Make sure if your state has income tax, state income tax, make sure to check what your state policy is. And state policies change weekly too, because state legislators meet and change their rules all the time as well. Now, if you are on that extension, no penalties or interest accrue during this time, which is good. However, just because the deadlines have been extended does not automatically mean that it's a great idea to sit back and do nothing. There are multiple reasons, and a couple of them I will mention throughout my presentation, that actually can make you interested in filing your return sooner rather than later. There could be very compelling reasons for that. It completely depends on your overall situation. That's why it's always important to have good professional help on the tax side in particular. 2020 IRA contributions. I say 2020. Yes, it's 2021, but you still can make contributions that will count as contribution for the year that is fortunately over, 2020. So the deadline is May 17th, as I mentioned on the previous slide, nationwide, or if you are in those 3 states like Texas, Oklahoma, Louisiana, June 15th. Sometimes IRA deduction becomes necessary for your tax situation. What I'm talking about next is what type of IRA you should contribute your money to. In particular, traditional IRA versus Roth IRA. So traditional IRA can sometimes, depending on your overall tax situation, give you a deduction this year. And the deduction could be critical for some people for various tax reasons. It's case by case. Sometimes you really absolutely need to have this deduction to drop your adjusted gross income to a certain level or for other reasons, and then the choice is made for you. Sometimes your income is too high where you cannot contribute to Roth IRA because of the phase out, okay, because Roth IRA contributions are phased out based on income. But in most cases, so if neither of those two applies, or if you are not sure, then what I put in red there, generally speaking, you would want to contribute to Roth. Why? First is, okay, the next bullet says, as a rule of thumb, and of course our thumbs are different. Okay, mine ideas, if you look at yours, they are probably different. They can have different size, shape, color, whatever, right? So my rule of thumb is that Roth is generally better. It's ironic because Roth was designed to be equivalent to traditional IRA in tax consequences, but we are not comparing apples to apples usually. So in real life, Roth usually beats traditional IRA under the current tax system. Imagine, like, notice that I have a disclaimer. Under today's tax system, our tax system right now is unstable. We don't know really what is going to happen in the future. But as of today, Roth has very strong advantages. So, and if you contributed to Roth before you filed your taxes, and then you filed your taxes and realized, oops, my income was too high. I did not know at the time, but it's too high. I'm not allowed to contribute to Roth. No big deal. What you can do is you can recharacterize that contribution and make it regular IRA contribution, traditional IRA, non-Roth IRA contribution. It may or may not provide you deduction. That depends on a lot of things that are going on with your tax return, but you can go from Roth to traditional without any problem. Can you go from traditional to Roth? Like if you, the other way around. So what if you contribute to traditional IRA and then decide to turn it into Roth? Yes, you can do that. It's called conversion. But that thing is not as reliable or guaranteed as recharacterization of Roth. We'll talk a little bit about that later. Conversion to Roth is currently threatened. There are proposals circulating in Congress that can either eliminate that conversion to Roth completely or limit that. So we cannot count on that much. And for people who could not contribute to Roth, a lot of people are counted on a so-called backdoor Roth contribution strategy, where you contribute to regular IRA, non-Roth, and then convert it to Roth later. As I said, it may or may not be available. Okay, so while you are doing that and looking at contributions for 2020, at the same time, I strongly consider you, strongly recommend that you also consider contributing for this year, for 2021. So you can double your contribution essentially at that time. Do contribution for 2020 and for 2021. Why now? Because you still have plenty of months, because the rules can change. And the way tax laws usually work, I stress usually, you never know how the new laws will be implemented, but usually they are grandfathered to a point that if you did something prior to the day the new law happened, then you can still use the existing rules at that time. But if you wait until after the law, you may not be able to do that. So if you are looking for those opportunities that exist right now, maybe it's a good idea to contribute and maximize your contribution both for 2020 and for 2021 right now, while you have existing laws that we at least know how they work. What the new laws will be doing, we yet don't know. The other part are IRAs are for everybody. Anybody can contribute to IRA, but if you are an employee of a company, or if you are self-employed and have active income, and I stress active because this is not really available for landlords with passive income. So if you have active income, you could have your own 401k in your company, whether it's solo 401k if you are just by yourself, or if you have your own employees. So if you are working for somebody else in corporate, it's too late right now to make contribution into your 401k for 2020. You can definitely do it for this year, but not for 2020 anymore. But as far as your own 401k, this is something that is extremely confusing, and I, guys, need to warn you what is going on. I actually checked before doing my presentation and discovered interesting thing. The IRS publication is behind. If you are going on the IRS website and looking at the IRS publication has outdated information. If you try to Google your answers and you will jump between different custodians, like from Quest to all other people who can help you with 401k, and compare what different companies are saying, you will get different answers to that too. Even my professional reference guide that was created in December of last year has it wrong. The right answer is this: because of Secure Act, which happened in December of 19, like a little over a year ago. For 2020, the rules have changed. Normally, you needed to set up your 401k by December 31st of that year. So in the past, today would have been too late to set up 401k for last year. But the rules have changed. The rules change all the time, as I mentioned multiple times by now, right? So you can still create a brand new 401k for your own company today for 2020 and find it with employer contribution. Cannot do employee contribution anymore, but can do employer contribution. So it's not too late. Highly recommended for a variety of tax planning purposes, which we don't have time to discuss right now. So initial deadline is extension deadline, which is May 17th nationwide or June 15th in Texas. But if you file extensions on those days, you can buy yourself even more time and extend it to September 15th or October 15th, depending on what type of entity you operate. Okay, so same as I said with IRAs, while you are contributing to your 2020 401k, consider contributions for 2021 as well, again, while we have current rules in place and can rely on them. The rules can change any minute with the new Congress and new administration. SEP IRAs have the same deadlines. You also can contribute to a different type of plan, a SEP IRA, which is different from 401k, and Quest has fantastic education explaining difference between different plans, advantages, disadvantages. So go look at the education available through Quest, and you will learn that. We're not going to talk about that today. There are actually a whole lot more varieties of different retirement plans, but again, we are skipping that right now. I only mentioned three most important ones, which is just individual IRAs, 401ks, and SEP IRAs. Okay, so that's as far as contribution for 2020. Right now, we are talking about distributions. Next part of our presentation, we'll talk about distributions, meaning taking money out of your retirement account. Pretty much everybody knows that the CARES Act, that COVID-related act from 2020, allowed you to take up to 100K from your retirement accounts and avoid the usual 10% penalty, the usual 20% withholding, and all those other different complications. Before I mention those rules again, let me point you to the top bullet point on this slide. Personally, I'm against taking money out of retirement accounts unless one of the two things happen. Either you really are strapped for funds because you lost your job, your business suffered in COVID, something else happened, and you really absolutely need cash and have no ways of borrowing money on good terms or any other way to fund your life or your business, and that's your last choice, then yes, taking money or out of your retirement account may be something that you should do. Okay, again, remember I will repeat what I just said, is that I consider that to be your last resort, not your first place to get your money, even though the rules currently allow you to do that. And second situation when I would endorse you taking money out of retirement accounts would be is if you have a deal that you simply cannot do within your retirement account, either because of prohibited transaction limitations or because of recourse versus non-recourse financing or some other issues that really you have some spectacular deal that you cannot miss. And the only way to fund that would be to take money out of your retirement accounts because you don't have better way of funding the deal, then yes, it could be something worth doing. But in all other cases, I'm a very strong proponent of keeping your money in your retirement accounts. Retirement accounts enjoy the best tax protection right now of pretty much any vehicle around. Excuse me. With just a couple of exceptions, but generally speaking, you cannot beat retirement accounts, particularly Roth retirement accounts, for their tax benefits and long-term accumulation benefits. And if they are self-directed, you can do those deals inside self-directed IRAs. Again, people, we are at Quest right now. I'm guest at Quest. Quest for many years have been educating investors about all the different opportunities of doing business inside retirement accounts. You don't have to take money out in order to run your business or do your deals. Okay, so that said is, okay, let's go back to what happened during CARES Act and COVID time. So you could take up to 100K combined from all of your retirement accounts. And the way it works is misexplained by a lot of people right now. I see multiple people on YouTube. I see articles written by people who I cannot stand. I'm sorry, I have a big problem with those freelance journalists who write about tax topics with a journalism or English degree, but no understanding of taxation. They believe that it's as easy as to write blog about their favorite brand of latte. No, it's different. You need to understand how the system works. And they badly misrepresent the situation and give bad advice. So be very careful where you get your advice from. Okay, so the way it really works is this. If you took that 100K during 2020, and by the way, the window is closed. Okay, you had to take it during 2020. Right now we're in 2021. You cannot take advantage of that anymore. But if you did take the distribution normally would be taxed over 3 years. 1/3 of that would be taxed in 2021, on 2020 return, the next third on 2021, and the last on 2022. So to take easier number, let's say you took out 90 instead of 100, just to have an easier number to talk to. So if you took out 90, you have to add 30,000 to your taxable income on 2020 return. Another 30 you would add on 2021 return, and the last 30 on 2022 returns. So then you have a 3-year window to repay it, but it does not mean that you do not add it to your tax return. A lot of people misunderstand that. They thinking is, okay, I will decide 3 years later whether I paid it back or not, and then I will decide whether to put it on your return or not. No, that's not how it works. If you took it out, 1/3 is taxable on 2020 period, unless you returned it to your IRA or 401k account before you filed your taxes. Then yes, you can essentially reverse that distribution. But if you keep that money at the time you are filing your return, first third of that is absolutely taxable. It's penalty free, but not tax free on your 2020 return. And sometimes you can even you are allowed to choose to claim the whole thing in 2020. And most people say, why would I do that? Why would I pay all taxes up front when I could spread it over 3 years? Everything in taxes depends on your situation. It could be for many, not for many people, but for some people, depending on the tax situation, advantageous to take everything in 2020. Example, let's say you normally have a high income and in 2020 you lost your job and your income was almost nothing in 2020. Then you may want to take that 100K distribution and pay the whole tax in 2020, because on this year in 2021, you might be back to your high tax bracket, and other scenarios exist. Also, if you repay taxes later, you will need to go back and amend your prior returns to take those taxable distributions out. But until you pay it back, they have to be on your return and you have to pay taxes on that. What happened then is, and also frequently misrepresented, that Appropriation Act, Consolidated Appropriation Act, which was the new law, the last major tax law under Trump administration, which was signed at the end of December 2020, that law has a new provision, which is called disaster distributions. Okay, so qualified disaster distributions have pretty much the same rules as those COVID-related CARES distributions. You again can take 100,000 penalty-free and distribute it over 3 years. It's pretty much the same thing. And they also have the same rules as CARES Act for loans out of 401k. You are allowed to take up to your entire 401k balance or 100k, whatever is lower, as a loan. So again, you could also do it for declared, for qualified disaster distribution. But many people misread it and misunderstood that. Number one, these are not COVID-related disasters. Yes, COVID was declared a national disaster, but this particular distribution is excluding COVID. COVID excluded. It would be natural disaster, and it also had to happen during 2020. So if in 2020 you were affected by COVID and separately you were also affected by some kind of natural disaster, which was declared a presidentially declared federal disaster, then you could take potentially both 100K under the COVID provision and 100K, different 100K, an additional 100K based on the disaster distribution. But again, it has to be separate disaster, which is not COVID, and it had to happen in 2020. Some people looked at the dates on that law and misinterpreted that, because the date said it had to be declared by the president by the end of February of 2021. Okay, and then people look as, wait a second, our freeze in taxes happened prior to that. No. What the rule said is it had to be declared before December, but it had to happen before February, but it had to happen before December. So the freeze in taxes does not qualify you under those rules. It had to be some disaster that actually happened during 2020. Okay, next. Roth conversion. Okay. So currently, like adding to my topics of decisions we need to make during the tax time would be Roth conversion. So currently, you can convert any amount of your retirement accounts into Roth accounts at any time without limitations based on how much money or how little money you make. So that thing can change at any time. There are discussions in administration, discussion in Congress that could at some point phase out that opportunity or eliminate that completely. So there is actually a proposal right now circulating in Congress to eliminate Roth conversion. I cannot tell you the probability of that happening, but it's out there. It's a real danger. So if you are considering converting to Roth, which for most people is a good idea, again, I stressed most. There is nothing in the tax law that is universal and applies to everybody. It could be a great idea for you, but not great idea for your brother. So it depends on your personal situation. That's why, again, professional tax help is extremely important, and not just somebody who can plug numbers into tax software and tell you what the tax software says. Somebody who can actually evaluate long-term implications of doing that. Sometimes Roth conversion is not the best. Sometimes you want to do partial conversion and leave some money in regular non-Roth IRAs. It's complicated area. Okay, so that's why tax planners, tax strategists are in such a high demand right now. Remember, I told you in the introduction, our company cannot do consultations for anybody except clients. Yes, we have too much demand for those things. We only help our advisory clients. So what you cannot do, however, right now is what has been eliminated is you can no longer do, you cannot unconvert Roth, which is called recharacterization. So that part of recharacterization is no longer available. Meaning is, in the past, you could take an account, convert it to Roth, and then when you figure out, oops, that was not a great idea for this reason or that reason, I want to go back to regular IRA, you could do that. Not anymore. So conversion to Roth is one-way street currently. So before taking that decision, you do need to give it careful consideration, but again, do not wait. Now, if you do decide together with your tax advisor that it is indeed a profitable move for you long-term to convert your accounts to Roth, what you want to do is you want to convert that account at the lowest possible value. Why? Because if right now you take a 200 IRA account and convert it to Roth, you will have to pay taxes on 200,000 next year because the conversion happens today. So it will create 200 taxable income in the year of 2021, and the taxes will be due next year. So you want to minimize the value of your account at conversion. Now, if all you have, all you hold in your accounts is cash, you cannot change that value. But if those accounts are at Quest, if they are self-directed and they are invested, you want to strategically plan the timing of your conversion too. Because first, to reduce value, you can choose time when you convert. For example, okay, let's say right now your self-directed IRA has a 75K in it, and tomorrow you go buy a note with that 75,000. The question is how much your account is worth today. 75. How much is it worth tomorrow? Whatever the note is worth. It's no longer 75. 75 at that point is face value of the note, but that's not the value of the note. You will have to get professional appraisal of that account and figure out how much the note is worth at that time. And it's definitely not worth 75. Now, and the longer you wait, the closer to maturity, the more it's worth. So you are interested, if you are having notes, to convert it when the notes have a lot of years left on them or when they are non-performing or have like whatever other complications. Another issue there is liquidity. So if you bought notes, their question is, can you easily sell them? No, not as easily as cash. Cash you can pull out all the time. But if you are invested in notes or or if you are a private lender and lend that money out, can you convert it to cashes? No, you would have to sell your note to somebody at a discount, and that can take time and may not be available, which depresses, discounts the value of your account. Then you can also play more sophisticated games and play games with control. What if your self-directed account invested into a joint venture with somebody else? It could be somebody else's self-directed account or just another unrelated party, right? So you invest together and now you have control issue, because not only you cannot convert your investment into cash easily, but you also don't have a decision power over that, because now you have partners. So there are a lot of sophisticated games and good games, which is tax planning type of games, can go there, which can depress the value of your account right before your conversion, which will save you a lot of taxes on the conversion, and is very much worth planning for before you pull the trigger on the conversion itself. So that's all as far as talking about deadlines and IRA issues. Here is, I promised you at the beginning to tell you where you can get your questions answered by tax professionals. First, if you are a real estate investor, you absolutely need to be a member of Bigger Pockets, this national forum of investors who are discussing investments and everything related to that. As part of Bigger Pockets, you have a tax and legal issues forum, which is on this slide. And as you can see, I'm one of the top contributors to that forum. People like myself, tax professionals, answer questions on that forum for free. So that's one opportunity. Next opportunity to get it is I host a private group on Facebook, which is called REI Tax and Legal Wizards. So in that group, we have multiple tax professionals, multiple lawyers, and we answer your questions there also for free. The group is private. You need to ask permission to join the group. We will gladly welcome you in as a real estate investor. We keep that group small. There are no spam or promotions there, just professional discussions and tax and legal questions. My firm itself, as I mentioned, is Rai Tax Firm. And what we are doing is working exclusively with real estate investors, but not on tax preparation. Yes, we do tax preparation, but it's a small part of what we do. What we do is we help your business in much bigger, much more impactful areas, specifically tax planning, tax strategies, adapting to new laws, and all of these things that make your business succeed and minimize your taxes. As you can see at the bottom of the slide, we have an entry-level program for beginner investors. We have a much more valuable program for experienced professional investors, which we call Black Belt REI program. Contact our firm at REITaxFirm.com. We will be happy to help you if there is a match between what we are doing and what you are looking for. And in case you wonder, yes, we have 5 stars everywhere on Google, on Yelp, on Facebook, all across the board. The second part of my presentation, as I promised, we are going to talk a little bit about the new laws. Again, that's a broad overview. We're not able to go into details. Each slide here could totally justify 1 hour presentation just about one slide. And maybe we wouldn't be able to fit it in 1 hour anyway. So I'm only doing generic overview. And one more time, I'm reminding you, if you look at the top of my slides, information changes almost daily. So information at the top is information as of today, March 27th. It could very well become outdated tomorrow, or possibly even by the end of the day today. Who knows? Things move extremely fast and unpredictable. So the stimulus payments are surprisingly still confusing to a lot of people, which is strange considering how much attention has been given to them. But basically, this is how it works. You had two stimulus payments in 2020, 1,200 payment early in 2020 and 600 second stimulus, which was in early January of this year. So you combine them, you get 1,800. 1,800 is what single person under the threshold would have received as a credit on 2020 tax return. That's how stimulus were designed. They were designed as a credit on your 2020 tax return. But that credit you received in advance as two stimulus payments. So what you do now, you add up these two stimulus payments. So if they are 1,800, then you do a tax return and it says, yep, 1,800 is what you were entitled to, then nothing else happens. Now, if you do your tax return and you only received 1,500 between the two stimulus payments, and the tax return says, no, you could get 1,800 based on our calculations. Great, and you will have 300 more, the difference you will get as a credit on your 2020 taxes. And if the other way it happened, that you got 1,800 stimulus, but then after preparing your 2020 tax return, you find out that what you received was too much and you were entitled to only 1,000, then it's your good day because you get to keep that extra stimulus payment. It's yours to keep, you don't have to return it. That third payment that was part of that March 11th law, that American Rescue Plan Act. So that third 1,400 payment does not apply to the year 2020. The 1,400 is a credit in your 2021 tax return, sorry. So it will come into consideration a year from now. So all you are getting with that one right now is an advance payment of 1,400 per person and or dependent for your future taxes due on this year, on 2021. Chances are it will work the same way, meaning is that if you got too much stimulus payment, you will get to keep it most likely. And if you got too little, then you will be reimbursed later on. There are very complex provisions in this new law on how you have catch-ups, how you can do those different things. It's extremely convoluted and complicated. Those rules are very, very strange. And those rules make playing some games potentially profitable, meaning currently the IRS has on file your 2019 return and it's going to calculate that 1,400 stimulus is going to be calculated based on your 2019 return because that's the return the IRS has on file right now. But if today you filed your 2020 return and the IRS has not sent you stimulus payment yet, then they will calculate it based on your 2020. And if your 2 years are different, it's worth getting a very serious consideration. Do you want to file your tax return quickly or do you want to wait on that? Those considerations can become important for stimulus as well as other considerations. Okay, unemployment. Unemployment benefits by that March ARPA Act. I call it ARPA. It's like American Rescue Plan from March 11th. So now unemployment is extended through September 6th, and it still has that 300 subsidy from federal government. Rules keep changing. Rules are modified by each state, so your state can have their own additional rules to that. What was important, very important in that law in March is that it made the first 10 grand, well, 10,200. I have no idea why they made 10,200. Beats me. Why not just around 10,000 or 15,000, whatever. No idea who came up with 10,2. But it's 10,2. So I call it tentatively 10,000, right? So the first 10 grand of your unemployment benefits for the last year, for 2020, is now non-taxable. For 2021, we don't know yet. So far, they are taxable. They may change the law later, but we don't care about that yet. We care about 2020. We especially care about that if you already filed your tax return early and counted your full unemployment as taxable income. The law was introduced after many people already filed their returns. The IRS right now says, hold on, don't file amended returns. The IRS is figuring out how it will be processing those changes. But effective now with some complicated rules again, as always, 10,000 of your unemployment is not taxable as long as you're under 150 of income. In an extremely strange twist, that law did not make a distinction between single and married people. So if you are single, your unemployment is tax-free as long as your income is 150. And if you are married, it's also tax-free as long as your combined family income is under 150, which can make considering filing separately and worthwhile. Sometimes people will need to evaluate. This law is this year is much more complicated, guys. With all the COVID provisions, all the new laws, there is much more thought and much more consideration you would need to put into filing your 2020 return and finding your best situation. By the way, keep in mind that joint return is a one-way filing. You can switch from separate to joint later, but you cannot switch from joint to separate later. It's one-way decision. So making all of the decisions now require careful consideration and possibly professional help. Now, what happened in some non-tax provisions in that new law that was from March? Non-tax meaning is not specifically changing your taxation, but what happened in that is a whole lot of programs were funded by this March law. So huge amount was allocated for rent relief. And as in the previous rent relief programs, you as a landlord you can apply on behalf of your delinquent tenants. But don't wait, because those funds, as generous as they were from this allocation, they still are in high demand and tend to run out quickly. So apply for those, educate your clients, apply on their behalf, educate your friends, employees, whoever else might be affected. There is also huge funding for homeowners who are facing foreclosure, huge funding for additional housing Section 8 vouchers, for restaurants if they are still in business. There is COBRA premium assistance. Okay, and overall funding for over 200 different programs. Most of them neither you nor myself have ever heard of, that those programs exist. Program for this type of assistance, if you are affected negatively by COVID, either you or people you know, your family, friends, employees, tenants, whoever. There's so many programs right now that provide assistance from all angles without any kind of centralized source of finding information. So tell me what is available. People are looking, people are finding, people are sharing. Okay, you have to keep your eyes open and just keep in mind that there is a whole lot of new funding that some of them is first time, never existed before, and programs will keep appearing, but most of those programs appear and get depleted instantly. So you have to do a whole lot of homework to find out all different sources of government assistance under this law, as well as any other previous laws. Non-business tax changes, they are quickly listed here. I'm not going to spend time on that. We are running short on time right now. And basically, okay, there are a lot of changes related to personal credits, particularly child credit, dependent care credit, earned income tax credit, and other changes. If anybody wants to have my slides, then please send an email to our company and we will gladly send you these slides if you miss something, because I'm running through them fairly quickly. Okay, next is changes on PPP tax treatment. If you got PPP, there was a lot of confusion throughout 2020. completely non-confusing anymore, except the last bullet. So the first three basically say PPP by now is established as having no tax consequences. PPP proceeds if the loan is forgiven is not taxable. If the loan is not forgiven, it's a loan, so even more non-taxable. And any expenses that you paid with PPP funds are completely deductible, so there are no complications anymore, except if your state decided to make PPP taxable. Believe it or not, some states chose to divert from the IRS decision and still tax their state businesses on forgiven PPP loans. So check with your states. Those rules keep changing too. State legislatures change their mind as frequently as the federal government. Second row PPP, which was established by the December law, you can apply for second PPP loan. Yes, if you had first PPP loan, you can still be eligible provided you qualify under all those conditions, but you may still be eligible for a second PPP loan. And you don't even have to wait until the first loan is forgiven. Your first PPP loan has to be spent, but you don't have to wait for forgiveness before applying for the second loan. Originally, the deadline was March 31st. As of yesterday, the deadline is moved to May 31st. So you have a little bit more time, but nobody knows how soon the fund will run out, the funds for that loan, and the backlog with the SBN lenders is significant. Many lenders will stop taking applications much sooner than the deadline. So if you qualify for the second PPP loan, apply as soon as possible, even though the new deadline gives you more time. PPP for Schedule C change happened very recently, a few weeks ago. SBA, with no warning, changed completely the way it treated PPP loans for Schedule C sole proprietors. Up until then, you could only get PPP based on the net income, on your income after expenses. And the way it worked is basically if you had a loss, you have no PPP. And suddenly, SBA changed their course 180 and said, you know what, for Schedule C, we are going to issue PPP based on gross income, gross, before expenses. So that opens completely different possibilities for PPP loans for Schedule C people. Again, it's a new change. What happened if you already applied under old law? Well, sorry, you probably are out of luck. That's what they do with these laws. Okay. What if you already apply, what if you have any other type of entity? What if it's not, you are not a sole proprietor, but you are more professional and using a partnership or an S Corp? Well, you still have to use net income there. That gross income is only for Schedule C sole proprietors. Why? Cannot explain you. That's the change in rules made by SBA very recently. Schedule E landlords still do not qualify for PPP loans unless you have employees on W-2 working for you. Then there are three credits, and we are almost at the end of our presentation. Okay, so that first credit is paid family and sick leave. What the concept behind that credit was, so if your employees need to take time off and cannot work because of COVID or because they needed to look after their child when the school was closed, etc., you were, as an employer, obligated to pay them, but the government would reimburse you. The new laws extended those programs again in a completely weird way. They apply differently to different rules. I had a more detailed webinar about that yesterday from my company. We can send you a link if you are interested. But keep in mind that those programs have been extended through the 2 more quarters, for the second and third quarter of this year. However, under strange rules, and rules are different for sick credit and for family leave credit. And then another strange thing that happened was that At some point, government decided that the self-employed people have to be on the same footing with employees, meaning also eligible for sick and family leave. So think about that. As a self-employed employer, you are letting yourself as a self-employed employee to take leave and you keep paying yourself. How does that sound? Weird? Yes, it is weird, but that provision requires you to complete a special form and can give you a credit, which could be material, like my example here on the slide says, yeah, you could under some situation get like a 3,000 credit just by claiming that you were sick. Now, you had to be sick. You had to be unable to work because of that. Who is going to verify that? Probably is nobody. But rules are rules. So if you choose to ignore the rules and lie on your federal tax return, remember that you are committing a criminal offense and could be put in and could be prosecuted for fraud at some point. Chances of that are probably not very high, but you are taking that risk, and whether or not to take it is up to you. The last of the credits is employee retention credit. That credit also was for situations when the employer pays their employees instead of firing them and letting them go on unemployment. And rules about that kept changing multiple times again. The most recent law from March extended employee retention credit through the end of this year, through the end of 2021. Again, details are different. You can have it compatible with your PPP loan, just not for the same wages. You can have both PPP grant and employee retention credit under revised rules, but you cannot use that to pay yourself. It's not for your own compensation. It's just for employees. Okay, unless we are talking about you being an employee of your own S Corp, then yes, then it works. And my last slide here talks about what else is floating out there and causes a lot of discussions. So increasing tax rate and capital gain rates. That was a big item on Biden's election campaign promises. That's still very much into play, and I'm almost certain that it's going to happen. Now, it may not happen based on that structure that Biden explained during the early period. Those things very well could change, just like Trump's ideas of tax reform have changed very significantly from his initial proposals to the actual tax reform of 2018. I expect the same will happen with Biden's proposals. The real law will be different. So we cannot tell right now how soon, how much those rates will change, but the fact that they are going to go up is almost certain at this point. Another famous proposal or infamous proposal from Biden administration was to restart Social Security tax for people who make more than 400K, whether it's on high W-2 income or high volume real estate investors, realtors, wholesalers, flippers, etc. So this is a very dangerous proposal for high income people, and it's also likely at some point to become a law. So I suggest if you are affected by those numbers, get with your tax strategist, with your tax planner, and discuss ways to mitigate that risk. Eliminating 1031 exchanges has been discussed for the last decade, not just during the last few months. I still consider probability of that to be relatively low, but I don't have a crystal ball. So I don't think that they will eliminate 1031 exchanges, but it's not impossible. So if that is a concern of yours and you are planning to get into one anyway, then you may want to start it sooner rather than later, because it's highly unlikely that the law would eliminate return exchanges that have already started. Okay, and next one, eliminating step-up base is one of the most dangerous proposals of Biden administration, because it's one of the pillars of tax planning for the last few decades. We all are used to counting, and that's the end game of 1031 exchanges, correct? So we are going to exchange until we die, and then our kids get it with step-up basis or tax-free. I do not think that step-up basis is going to disappear. Proposals are being discussed, but personally, I expect this to not happen, but who knows? Changing retirement plan rules are going to happen. Again, nobody knows. There are lots of proposals, and personally, I'm not a big fan of doing planning based on hypothetical scenarios. So what if they decide to change retirement rules this way or that way? History of tax law changes shows you that it's a not very productive way of investing your energy into planning your tax moves based on laws that are not yet close to becoming a law. But eliminating Roth conversion is an exception. Like possibility of that is here. So if you are looking into Roth conversion, as I just explained before, I do encourage you to do it sooner rather than later. So in the face of all this uncertainty and things that we no longer can rely on, what can we rely on? In my opinion, it's just three things. We can still rely on our family. We can still rely on our faith, whatever that is. It could be faith in yourself or faith in your business, or could be spiritual or religious faith. And of course, we can always rely on our best friends who will never let us down, unlike the federal government, unlike this guy who is standing behind me, smiling. Again, I'm Michael Plaks, in black belt in real estate taxation, and working with real estate investors since 1996 for 25 years. And my company is Rai Tax Firm. We'll be happy to help you if we can. Okay, now, Nicole. Okay, I think, we pretty much used up all the time available, but if there are some questions that you want me to try to answer, I'm here.
Absolutely. That was really a lot of amazing information, a lot of great points there that I'd like to touch on if we have a minute. We do have a question about getting help on foreclosing. I assume this question is for closing on someone who is probably either not paying rent to their landlord or not paying on a note. Would you have any words to share with us on that?
Unfortunately, no. Okay, this is
Sure.
not my area.
Yeah.
Okay, I'm a tax guy. I'm not
Yeah.
working with those programs. But what it basically does is there, for example, okay, if a person is qualified under those rules, and for example, who would qualify? People who qualify for unemployment would be under those rules. People who qualify for food stamps would be under those rules. So if you qualify and meet those thresholds, then the programs would allocate some funds, like give you some money to catch up with delinquent property taxes or delinquent mortgage, to delay potential foreclosure because the moratorium has not been officially extended. So, but again, that's not really my area. This is something more for real estate lawyers.
Okay.
To look
Perfect.
into.
Well, thank you so much for sharing all the information today. The information that you shared about Roth conversions, I thought was really powerful. About staying in your actual retirement plan and using distributions is really, a last effort there, or really when you're in retirement. What would you say is the last takeaway you would really want to share today to everyone? I know you shared so much information that I really thought so much of it was so valuable. We're getting lots of really great comments here that the information was so valuable and so needed. So we really appreciate you joining us today. But what would you say is just one takeaway that you'd want to share with everyone today?
Nicole, can I have two instead of one?
Absolutely. You can have 5 instead of 1.
No, I'll take 2 because one will be self-serving. Okay.
Sure.
So, and then I have to be unselfish with the second one. So the self-serving will be is, as my presentation hopefully illustrated, right now it's more important than before to have competent tax advice, and not just advice on how to do your return, but how to plan forward. There are a whole lot of people who can do tax return correctly, but not that many people who can help you evaluate your strategies going forward. So those people are relatively few, particularly those who specialize in real estate, and we are in high demand, and we get higher demand as we are getting closer to deadline. So if you are looking for help, try to get competent help as soon as possible. Okay. On the less on the second one, which is not self-serving, would be this. We looked at 2020, and when 2020, all this COVID started, one of the webinars I did was uh, what COVID could bring for real estate investors. I was not talking about taxes. I was actually sharing my views on general, like from an investor perspective, what can we expect, how we can change our business. Half of that was on point, half of that I missed completely because it's hard to estimate. But here
Of
is a very
course.
interesting like observation that I see from my clients. Remember, again, all my clients are real estate investors. My clients are all over the country. So in every state we have a client. I believe in every state. Like might want to double check my statement, but I think we do. So we have clients all over the country and in all types of real estate investments, different types, different strategies. And what we saw is that in every facet of real estate investment, despite all of the challenges of the COVID year, some people did exceptionally well. So my take home from that would be, it's not part of my presentation, but it's my observation as the guy who actually sees the numbers. Like people can go on social media and brag all they want, and I can sneaker in the
Sure.
back because I know that that person is, let's put it this way, exaggerating his or his success. So a lot of people are not telling the truth. But during this time, still, there are a lot of investors who are doing exceptionally well despite all of these challenges. So don't get discouraged by seeing how things are complicated. Look at them as opportunities and seek out people who are excelling in this environment and learn from them what they are doing to reposition their business and be successful. I'm pretty sure that 2021 will be no different. Investors will always find a way to make money, be successful, and improve lives of other people who are affected by their business.
Wonderful advice. Well, I really appreciate you being here with us this Saturday. Amazing information that you shared with us. I really enjoyed watching the presentation. I took a couple pages of notes myself. I really enjoyed it. I'm sure everybody else did too. Thank you so much for being here with us this Saturday. Thank you to everybody here joining us. I hope everybody has a wonderful afternoon, and we'll see you next Saturday for Self
Thank you,
Directed
everybody.
Saturday here with Quest Trust Company. Thank you, Mr. Plaks. We really appreciate you
Thank you,
being here.
Nicole, and everybody at Quest. Thank you.
Absolutely. We loved having you. Well, everybody, have a wonderful afternoon, and we'll see you next Saturday here at 12 Central, just like every Saturday. Goodbye, everyone, and have a great afternoon.